Ready to go? At Metro Transit, we are. With more routes to more places, easy ways to pay, and more convenient options, we're ready to go further. Go easier. Ready to go? At Metro Transit, we are. With more routes to more places, easy ways to pay, and more convenient options, we're ready to go further. Go easier. Go faster. Go, go, go. And go. We're ready to go. Are you?
Fit Podcast. I'm your host, Andre Creighton. I am truly excited to be here with you all today. This has been an extraordinary 2025, and I look forward to seeing what more is to come this year. Uh,
Ready to go? At Metro Transit, we are. With more routes to more places, easy ways to pay, and more convenient options, we're ready to go further. Go easier. Go faster. Go, go, go. And go. We're ready to go. Are you?
Hey everyone, and welcome to another episode of the Financially Fit Podcast. I'm your host, Andre Creighton. I am truly excited to be here with you all today. This has been an extraordinary 2025, and I look forward to seeing what more is to come this year. Uh, if you're new to the podcast, hopefully you find something fruitful in our conversation today. So welcome. If you are a returner, thank you for continuing to rock with me. I really appreciate your support. And please feel free to share this with others. Hopefully, this podcast can be helpful for others that are on their financially fit journey. This is truly a grassroots podcast. We really are trying to talk through very foundational pieces that will help you hopefully build wealth over time. With that being said, today we're going to talk about how much is too much. Really getting into the hidden risk around concentration within your stocks. And the reason why this is important, right now we're in such a volatile marketplace with when it comes to the stocks. If you think about where we started in early 2025, the year took off really well, right? I think there's a lot of excitement about the new administration from people across the country, around the world, that are invested in the stock market. And we saw the stock market move in such way. Since then, we've had a lot of things that have formulated, such as tariffs, and I think that has kind of helped push down a lot of guidance that comes from a lot of these companies. So with that being said, it really is an opportunity for us to really look inward and think about our strategy and how we're approaching the market and really be able to evaluate our stocks and understand, are we concentrated too much in one stock? Are we not concentrated enough in another stock? And what does that truly look like? So this is something that I care deeply about when it comes to stock concentration. I really try hard to make sure that I'm diversified as much as possible. So, for instance, I'll just maybe share a little bit about my personal story. So I have about 8 to 10 stocks right now that I'm invested in on an individual basis. I rebalance those throughout the year, throughout the month. depending on kind of what the guidance outlook is, and then also how the market is moving. So, if I look at my portfolio right now, I have a lot of concentration in UHG. And a part of that is I got in when the stock had dropped. So I put a lot of money into it because my belief is that UHG will turn around. They've been hit with some pretty bad news from, back in December. One of their executives was murdered in New York. And then we fast forward from there. They they had some bad press around not sharing, being very candid, I guess, with their shareholders and their board of directors around increase in premiums for Medicare and some of the costs associated with that and Medicaid, and that has driven up price and hurt profits. And then fast forward a couple weeks ago, the CEO Andrew Whitty actually stepped down, and it comes out that he's being looked into for fraud. So there's a lot of turmoil right now with the company. This is a company that was at about $600 per share in Q1 of 2025, and now they're all the way down to a little under $300, right? So the stock is heavily discounted. This has been for a very long time a U.S. stock darling for a lot of individuals. UHG has been kind of the cornerstone of stock that people had in their portfolio. So I do believe that in the next year or two that this stock will get back to where it needs to be. But I'm a little heavily concentrated in that stock right now, about 25%. That's a lot more than I typically like. The general rule is that we want to be about 10% or less per stock. Um, I think, we do leave room for that 15 to 20% being acceptable. Depending on your conviction, depending on if there's hedging or if there's a short time horizon or you think that the stock is going to turn around pretty quickly. There's times where that can be more acceptable. But general rule is that we want to see 10% or less per stock. Uh, is kind of the moat. Uh, I think there's a lot of risks that people don't talk about. They don't talk about, company specific news. As I just mentioned, I talked about the three kind of big news that UHG had towards the end of last year and then into this year that have kind of affected their stock. So, I mean, we're talking a huge, huge drop in stock for United Health Group. I think also too, like that we don't talk about the sector drag. So while UHG might be underperforming, what is the overall sector doing, right? We need to make sure that we understand what that sector, that industry is doing, and how the stocks are moving in that industry, because that will be another indicator that will tell you how the potential stock that you're invested in may do in that specific industry, or what I always say is these are data points, and uh, the more data points that you can collect to help you make informed decisions will only help you. One, get into the stock at the right time and get out at the right time, right? Because that's the goal, right? We want to create some profits from the stocks that we invest in, and we want to be diligent about not being too greedy on those stocks. The other thing too that I think is very important, and this is a little bit, it's tied to stocks, but it's not more so on the concentration side. But I also watch the Fear and Greed Index. So you can go to CNN.com, and they have a Fear and Greed Index. And actually, let's take a look and see what the Fear and Greed Index is today. So bear with me for a moment. So today, and what this Fear and Greed Index does is it tells us a little bit about investor, um, just their sentiment around the market. So today, the Fear and Greed Index is showing 66 out of 100, which the dial is pointed at greed. So basically, they break it up into about five different dials. There's extreme fear, there's neutral, there's greed, and there's extreme greed. So what this is meant to do is basically tell you what the sentiment of the market is for and really kind of hint at market momentum. So obviously, if there's extreme fear, you probably are seeing a lot of selling. It's not always true, but you likely are seeing it's an indication that there could be sell-offs or people looking to sell. A lot of buyers aren't in the market. They're kind of in that holding stage. As you approach fear, you start to see the needle move a little bit more, and then neutral, really it could go either way. Now, once you get into greed or extreme greed, now you're probably seeing more people buying, potentially more people selling, and then rebuying at a lower point. This is just, in my opinion, one of the really, really good um, kind of another data point I would say that I like to look at on a very frequent basis to make sure that I'm understanding what market momentum looks like. So take a look at that. Like I said, CNN.com, something if you're in the market, you definitely should be looking at on a pretty regular basis. Um, so getting back to kind of the concentration, we want to make sure that we are gradually rebalancing on a pretty frequent basis. So what does rebalancing mean? You might ask yourself. So I mentioned that I have about 25-ish% of my stocks or my portfolio is invested in UNH, which is United Health Group. Uh, so over time, I've kind of bought a lot of the stock that I really want to have and hold for the next 2 years in UNH. Now, if it continues to drop more, I probably will buy some more over time. But right now, I don't have an outlook that I'm going to buy more UNH stock. My thought process right now is my other seven to nine stocks that I have, I am going to buy more of those to rebalance my portfolio so that I continue to decrease the amount of concentration that I have on UNH. So my goal is to get that back down to 10%, uh, where 10% of the stock is probably UNH or less. So with that, I will be focusing on those seven or nine stocks and investing on those over the next 6 months, unless something crazy happens with UNH, where one, the price drops, by 20% or more, is kind of my target, or if uh, the stock has some, good news comes out after Q2, and they've gotten rid of their guidance for the year. They just don't know what's going to happen. But let's say that they earnings are higher than maybe they had hoped or expected, and the stock starts to creep back up. I may look to sell off some shares too, which also will help me rebalance my portfolio. Um, I don't like to talk a lot about options on this podcast just because they're very risky, and quite frankly, I don't do a lot of options. Yes, I have a couple options out there right now, but they're kind of low risk in my opinion. But you know, there is some ways to reduce your exposure by, doing some options plays for protection. So, whether that's a covered call or a put, I'm not going to get into what those mean because I right now we're really just focused on the foundational things. The other way that you can rebalance is rotating into ETFs and index funds. So, if you're wondering what ETFs are a combination of a lot of different stocks um, to help you really diversify your portfolio. And honestly, it really helps you mitigate risk. You're probably not going to get the large returns that you could have if you just invested in a singular stock, but you will get that consistent kind of gain depending on the ETF that you're invested in. The one other way that I like to use ETFs is I like to look at the ETFs and see what is the percent of holding of each individual stock in those. And I look through those ETFs and see how those have been repositioned over time, and like are there consistent ones that are a part of ETF portfolios that are doing really well, because that is an indicator that maybe I should put that individual stock on my watch list and continue to watch that stock and see if it's something that I may want to add to my buy and hold portfolio at some point in time. I'll also share, just kind of as we're ending sort of this episode, one thing that I like to do is I like to have about 3 to 4 stocks of my, like, I said I have 8 to 10 stocks. I would never do probably more than probably 12 to 15, but right now I have about 8 to 10. I typically like for about half of that portfolio to be stocks that are long-term buy and hold. Like, I don't foresee me selling any of this stock uh unless like something crazy happens, like it just really takes off and I want to take some profits out of it. But about 3 or 4 of those, I'm putting money in constantly. I'm watching the volatility, and on dips, I'm buying the dip. On if it increases over, I would say between 10 to 15%, in a month or so. I may buy some smaller shares just to kind of stay in the game a little bit. Um, and then, so that's 3 or 4, and then I usually have about 2 stocks that are like super risky. Like, I'm talking like they could fail tomorrow, and I could lose it all. But the reality is that I like to look at about 1 or 2 of those, and I try to find like ones that fit into my thesis that I have high conviction on, that I believe the company has a lot of promise. So for me, one of those companies is Lucid. I think it's selling at about $2, and last I looked, about $2.60. So what they are is they're EV. They produce EV vehicles, similar to like a Tesla. Tesla is one of their competitors. They're newer. Their CEO in the past had done some pretty shady stuff where he basically was like one of the highest paid CEOs, but wasn't very merit based or incentive based, and took a lot of money from the company. So the company doesn't have a lot of free cash flow to invest in um, deployment and growth of their vehicles. Now, they do have money to invest in those things, otherwise I wouldn't invest. But they could be a lot further along if the CEO had done a little better, done right by the company. But this is a risky one. I do believe their technology is really strong. I invest in them because I think there's a lot of upside. This is probably like a very long, like 2030, between 2030 and 2035 is kind of my outlook, to see like what is the stock doing and has it performed over the next, gosh, uh, 5 to 10 years, I guess is so to say. Um, Another one that I view as kind of more riskier, which they're not at a place where I'm worried about them going under, so I guess they're not like as risky as like a Lucid. But SoFi is another one. They're growing their user base very rapidly. I think modern day banking is kind of, I won't say in the past, but I think that these next generations are going to look at modern day banking a lot differently. So SoFi is another one. And then, I also like to keep like, so that's 6. And then like the other maybe 2 to 4 are companies that are like, I buy them, I know that they're super volatile. And once they make their large gain, typically around 10 to 15%, I'll sell them. And then I'll repurpose that money into these other stocks. So I have about 2 to 4 stocks that I kind of rotate in and out of in that market, in that space as well. So 3 to 4 that are like buy and hold, I don't ever touch. 1 to 2 that are like super risky, like could go under, and then another 2 or 4 that are like that I kind of buy and flip. It's kind of like buying a house and flipping it, right? Like I have 2 to 4 stocks that I like buy and I flip them, take my profits, and I run and I dump them back into other pieces of my portfolio. So, with that being said, I hope that you learned something today. I just wanted, this is not investor advice. I'm not a licensed financial financial advisor, but this is what I'm doing. This is kind of my approach, and you have to define what that approach is for you. And I think it all starts with your risk appetite. So define how much risk you're willing to take on, and from there, you should be able to build kind of what your investment strategy should be. So, with that being said, thank you so much for being here today. As I always say, it's not about how much money you make, the power is in how much money you keep. Thank you so much for being here with me today. Have a wonderful day.
You know Shaletta makes you laugh, but did you know Shaletta Brundage can also make you think and boost your business? Media personality, activist, and comedian Shaletta Brundage founded Shaletta Makes Me Laugh to celebrate and share the best of Black culture. It's a podcasting platform. You can download 10 weekly podcasts hosted by African-American subject experts at ShalettaMakesMeLaugh.com or wherever you find your favorite podcasts. ShalettaMakesMeLaugh.com is also a production house, creating broadcast-quality commercial content. And Shaletta and her team of storytellers create powerful promotional campaigns to get businesses the brand awareness they're looking for. Some of Minnesota's top businesses trust Shaletta, and you can too. Get out the word about your events and products and get in front of communities of color with ShalettaMakesMeLaugh.com. She's got the power to help your business.
Nystrom is a manufacturer of specialty building products. We've been partners with Bremer for over 20 years. Through our relationship with Bremer, we've actually doubled in size over the last 10 years. We've been able to secure a working capital line of credit, equipment financing, real estate financing, and take advantage of their treasury management solutions. It's really been an invaluable partnership to have Bremer behind us and support us.
To keep my home running smooth, I count on Xfinity Internet. With 99.9% reliability, we're all online at once. No slowdowns. The Xfinity app lets me manage our Wi-Fi and keep things secure. Xfinity makes it easy.